This is a crazy paradox in the stock market. It should actually be in the Ripley's Believe It or Not. The stock market is the most incredible wealth building tool ever. It relentlessly marches upwards if you invest in low-cost index funds and hold on to them for long term. The Dow Jones started last century at 66 and ended at 11,400. That's an annual return of 10.3% with dividends reinvested. Despite that, most people lose money in the stock market. But if you don't commit these 4 mistakes, you will not. Here's a trap we often fall into. You see your investment portfolio fall by 20% and you panic. You remember the advice that you should not sell in a panic because markets always go up in the long run. So there's a conflict between your emotions and your mind. Your stomach begins to churn and you almost feel sick because your body reacts to your emotions or your thoughts. So after a few months, days, or even hours of this panic, you sell at a low. But the markets begin to rise again as they inevitably do every single time without an exception. And you start gaining your nerve back long after market has crossed the previous high and you can get into the market again. The loss of nerve ends up costing you a lot of money. It's an expensive lesson investors pay for again and again, generation after generation, even though it's a free lesson available for everyone. This applies to all of us. Maybe it's just the way humans are wired. It's not a lack of intelligence. Like Warren Buffett said, success in investing does not correlate with IQ. Once you are above the level of 25. However, once you have ordinary intelligence, you need the temperament to control the urges that get other people into trouble while investing. It takes an act of will and effort to understand, accept, and change this destructive behavior. Here's a sobering fact. The vast majority of mutual fund investors manage to get worse returns from their funds than their funds themselves generate and report, even if it is one of the greatest mutual funds in the world. Peter Lynch, who formerly managed the high-flying Fidelity Magellan Fund from 1977 to 1990, is a legendary investor. Under his management, his fund averaged an astounding 29% a year. That's actually a ridiculously better track record than Warren Buffett, whose long-term return is only 20.1% between 1965 and 1921. You would think investors in this fund would have done very well financially. But the average Magellan fund investor lost money when Peter Lynch ran the fund. Let that little nugget sink in a moment. How can that be?
What is going on?
It happened because we can't help time the market and jump in and out almost always at the wrong time. This is also why most stock investors lost money during the last century, even though the Dow Jones Industrial Average Index generated 10.3% yearly. They all felt they could time the market, but couldn't. Their minds systematically misled them. Here's an analogy which might help understand why stock picking is hard. Imagine you are going to an antique fair that's going to be in town this weekend. You're not looking to buy anything in particular. Instead, you're hoping to find a good deal among the several thousand items for sale. Something that's significantly underpriced, which you can sell on eBay for a lot more than you bought it for. What factors would you say determine whether you'll find such a deal or not? Here are 5 factors. There could be others, of course. How early you arrive.
Get up at 5:20 and the only reason we get up that early is for antiques.
Being the first has an advantage here. How many other shoppers there are. How well informed the other shoppers are. Whether you have any relevant expertise. If you have an encyclopedic knowledge of Victorian era furniture, that could be helpful. And 5, how much time you spend looking. So you arrive at this market as soon as it opens on Saturday morning. At least so you thought. You promptly learn that you misunderstood when it was going to open. The show opened yesterday. Thousands of shoppers, including many experienced antique bargain hunters, have already been through, picking over all the items. In fact, you learn from another shopper that many of the vendors shopped around at other booths, buying items they thought were underpriced and then putting them back up for sale at their own booths at higher and more appropriate prices. So how optimistic are you now that you are likely to find a bargain worth buying? Probably not much. That's a milder version of the stock market. The actual stock market has been open for many years now, and there are literally millions of other shoppers. Thousands of professional bargain hunters shop daily. with the help of a large team of researchers that they employ, all of whom are highly motivated and super smart with many years of experience. For instance, they spend millions of dollars buying live satellite images of Walmart parking lots worldwide to analyze customer demand and gain an edge over other investors. So there's a good chance you have no relevant expertise that will give you an edge. That is why stock picking is hard, even for professional fund managers. Among domestic equity funds, while 90% have underperformed the S&P Composite 1500 over the past 20 years, an even greater 95% did so on a risk-adjusted basis. Over 20 years, nearly 70% of domestic equity funds and 2/3 of internationally focused equity funds across segments were confined to the history books. Occasionally, you can beat the market, and when you do, it's a very heady and seductive feeling. You immediately start thinking you can do it again. The internet is full of winning strategies that feed this delusion. It's a delusion because beating the index over a long term is exceedingly rare. So rare that the few who were able to do it, like Warren Buffett, Michael Price, or Peter Lynch, are household names. They are absolute rock stars. Even though it is the truth, it makes dull television to watch people say that no one can predict the stock market. It is exciting when someone predicts that the market will double in the next 2 years or collapse by 90%. In addition to excitement, reputations and careers are made when such extreme predictions come true, as they occasionally do. And if they are wrong, there are no consequences. That is how the stock market TV game is played. You might think I might not be able to compete against professional investors who spend millions of dollars buying satellite images of parking lots, but I can pick professional managers of actively managed stock mutual funds and pay them additional fees to beat the market, right? Wrong. Choosing an actively managed mutual fund is as tricky as choosing an individual stock. In both the cases, you are investing in the individuals that run the company or the fund and trying to find people who do a better job than others. At least stock pickers realize, for the most part, the challenge they have undertaken. Mutual fund investors don't. Mutual fund companies spend massive amounts convincing people that choosing a fund is easy. It is not. Marketing expenses account for 1/3 of the total cost of active management in the mutual fund industry. Almost all marketing expenses are eventually passed on to investors, increasing the expense ratios. Actively managed stock mutual funds are a vast and a highly profitable business. Fund managers have Ferraris and yachts, but never the fund investors. They are so profitable that there are more mutual funds than stocks in the US and probably the rest of the world. Mutual funds are not exactly known as champions of transparency. For example, imagine you send 100 bombers on a mission. 50 crashed and 50 dropped their payloads and returned. What if you looked at the 50 that returned, called the mission a success, and then wrote a report that never mentioned the 50 lost planes? That's essentially what many mutual funds and investment data providers do when they report the performance of actively managed mutual funds. The old joke apparently is doctors bury their mistakes, mutual funds close or merge theirs. Over the past 20 years, nearly 70% of domestic funds and 2/3 of internationally focused actively managed equity funds across segments were closed or merged into other funds, according to research by Standard & Poor's. Only 5% of domestic funds outperformed the index over the past 20 years. And you cannot know which ones will outperform in future. The most ignored sentence in every mutual fund prospectus is past returns are not a guarantee of future performance. It is also the most accurate. In addition to underperforming index funds, actively managed funds cost more, severely and negatively impacting your results. The stock market is not the underlying business. A stock market is only a report card of the underlying business, a highly imperfect one at that. So imperfect that Benjamin Graham, the author of Intelligent Investor, the greatest investing book ever written, says Warren Buffett, compares the market to an alcoholic maniac depressive that gives a quote on the underlying businesses many times every day that wildly vary. You should ignore these quotes. Learn to look at the underlying business like an apartment or a farm. If you try to buy or sell your stock investments based on news or what your neighbor tells you, you will not do well like most other stock investors. Instead, just buy into an index fund and hold it long term. Nobody can tell what price the alcoholic, maniac, depressive Mr. Market will go tomorrow or the next moment, not even Warren Buffett. Another thing you should learn to ignore is the news. Especially when the markets stumble, news headlines are the last things we should listen to. That's because when stock traders lose their confidence, liquidity in the market drops and everyone becomes more sensitive to volatility. When you add some inflammatory headlines to the mix, stock prices can whip around madly, scaring many skittish people into selling. In the recent past, many scary headlines have spooked the market. They've tried to convince us that Joe Biden's win would tank the market, that we wouldn't recover from the COVID-19 market crash for years, and more recently, that inflation will rattle the whole world's economic recovery as the economy reopens after the pandemic. Many of you, I'm sure, remember seeing these scary headlines on TV and the internet. You probably got scared and sold, but the overall picture has been a distinct upward trend despite the various news stories. It's important to realize and constantly remind ourselves that the news media is for profit and makes it money by selling advertising. We are more likely to click on negative news that is emotionally charged. More clicks will help them sell more ads. More ads means more money. We are dying to know what happens, so we click. And often we see a sponsored ad before we can view the story. It leads if it bleeds is the business model of the media. If you are smart and want to build wealth over time, you will ignore news and stock market reports. When you look at the daily news, it is impossible to separate noise from signal. This is why company share prices can collapse one day and soar the next. This is also why stock market experts can make bold predictions that are often contradictory and wrong and get away with it. But you know that there is a lot of dangerous noise. Practice ignoring daily news and stock market reports and you'll miss out on the noise, not the signal. If you enjoyed this video, I recommend you watch this one. You'll definitely like it. I'm Sharat Mantravadi. Thanks for watching.